The asset class I'm kind of worried about is kind of U.S. equities because that's where you have a lot of euphoria lately. You don't see a ton of euphoria in international stocks. You don't see a ton of euphoria in value stocks. You don't see a ton of euphoria in Bitcoin and adjacent spaces for some of the reasons we covered here. Kind of the enthusiasm right now is in equity. One of the concerns I'm watching, because there are two directions that can go bad for equities. One is that if economic data continues to deteriorate in recession, that's generally not good for equity. And then two, if you get a reemergence of some energy inflation, we're seeing signs. Crude oil's been firming up a little bit. Gasoline's been at like year highs. The past year you had the SPR drawdowns. You had Iran get more of their oil to market. There's been a number of supply and demand, and if this starts firming up, then you take away that disinflationary component that's been there for the past year. And if you start putting that into the market, that has implications for long bonds. That has implications for net policy, which then can to equity valuation. And we have to see. So the past several months, the Treasury has been really focusing on T-bill issuance. They've been funding themselves at what is ironically the most expensive part of the curve right now, because that's the best for liquidity. That's how they're able to get liquidity out of the. Some of the estimates are that they might shift more towards coupon issuance later this year, and that could have implications for the shape of the curve and for overall liquidity. Like, where is that going to be funded? Because coupons are not going to be funded with. And so that's a potentially a different liquidity environment. So I do think that there are significant risks later this year, and I don't know if they're going to say transfer over to Bitcoin or not, or if Bitcoin's going to kind of trade more like gold, where they're about earnings in a way that equities do. It very much tends to be a liquidity play more often than not. So I think that's one of the key things to watch, is that equities have two sides of the area to worry about, where some of the other asset classes, I think are a little bit. I'm not expecting a pivot anytime soon. But like Mike, I expect generally like equities to not have very good performance, and that doesn't necessarily mean a crash. It is you can have a choppy range for a while. And this particular rally has gotten higher than I would have guessed. But even if it touches nominal new highs, I just don't think that basically measuring from the late 2021 peak to 5+ years after that, I don't think that's going to be looked back upon as a very good period of equity returns. And I don't know the path we're going to go along to get there. But when you go into it with high valuations, and then you run into some of these headwinds, the Fed fighting against you, some inflationary pressures, it's kind of a recipe for not great performance. And I think when we look at the economy itself, one thing that the market has been consistently off sides on for the past few years is the power of there's been so much focus on monetary policy, but I think it often underestimates the power of fiscal. And so the amount of inflation and stimulus that 2020 and 2021 fiscal injections were underestimated until they started materializing. And then even now, even with that period behind us, the sheer size of the deficit we're still running, I think is a key variable for why a lot of this keeps getting pushed out beyond what the market thought. Because it's a different type of fiscal, but it's still a type of fiscal. And then, it's offset partially by, everyone's kind of surprised by China's lack of in their reopening. And again, it's largely a fiscal question. Basically, they've been in the opposite. They're running very tight, and that's been a key variable for why they've been slow out of the gate. And so I think kind of the main thing to follow on a lot of this is what's happened with fiscal, because I think that the market's generally offsides in terms of either when it's either working in your favor or against you. Is just the sheer power that fiscal has compared to other variables we can look at, like monetary and elsewhere. So I classify it as a moderate event. I think it's more impactful for certain financial prices than for the economy. And so when we look at their yield curve control, they kind of struck the middle ground. So instead of actually increasing their yield curve control targets, they said, okay, we still have the same targets, but we're going to be more flexible in those targets. And so now, whenever JGBs trade between 0.5 and 1% yield, they're never quite sure if it's an intervention or not. It's kind of like the game they play with their currency over the past year, where they could come in with an intervention, and so probably the right price for it to settle somewhere between those figures. And when we think about the purpose of raising rates in the face of inflation, there's kind of two main ways to think about it. One is that if they're trying to slow down bank lending, which I don't think Japan's trying to do, because they're not exactly known for their rapid bank lending environment. And then two, it's you're trying to firm up your currency. You're the yield differential. You're trying to bring capital home versus have it go out. I think that's obviously the bigger story that they're trying to go with. And so to the extent that they're successful in that does all around the margin bring capital back to Japan, or at least stop some of the outflows, which has implications for global bond pricing, and then has implications for global equity pricing. So it's another risk factor among the other risk factors we've been talking about for things that derail the equity rally. But I don't think it'll be hugely impactful for Japan's economy, around the margins. We're talking about a fraction of. Well, I think that's the framing to think about, is that basically we have the fiscal side is still, pro-inflation, pro-expansionary, and is being offset by central bank trying to be restrictive. And I do think that the balance sheet reduction is probably having in some ways a bigger impact than the rates, at least around the margins. The fact that balance sheet reduction is still going on, and so the question is, if you have significant fiscal expansion combined with that monetary tightness, that's when you risk the crowding out effect, and that's we saw it manifest in the banks. We can see it manifest again in other areas. We could that could be a catalyst for the next stock market correction. Is that if you're still issuing more and more treasuries, those have to be funded, and that has to come out of somewhere. And if it's not coming out of the Fed, it's going to come from, right? So that's one variable to kind of, I think, watch. And I think you can have an environment where it's somewhat stimulative for the economy, those fiscal deficits, but not stimulative for asset, because it's not combined with central bank money print. Now, should they run into a hard liquidity problem like they did in September 2019 spike, or the March 2020, or the gilt crisis 2022? If they have an event like that, or the banking issue earlier this year, if they run into one of those events and they have to reverse their balance sheet reduction and then flip towards monetary expansion, at the same time you still have the structural background fiscal expansion, that's when I think it'd probably be, off to the races, second wave of inflation. But until then, I think we're still in somewhat of a disinflationary period. Most inflationary decades came in waves. And the one time where you didn't was like, say, World War I. You had this huge spike in inflation. Then the war's over, and you had that kind of post-war recession period of deflation. You kind of settle at higher plateau prices. Both the 1940s and the 70s, inflation came in waves. And the way I've been characterizing it this time is, we've been in this period of falling PMIs, economic deceleration, not as quick as people thought because of that fiscal backdrop. I think that as long as we're in this kind of economic malaise, the risk still trends towards disinflation. But once either we get a liquidity problem or some other event, and we start to have a period of reacceleration, I think it's likely to come back with some inflation on the side, because some of the structural drivers are still there. There's still the background fiscal deficit. I think there's been generally underinvestment in some of the energy and commodity markets, and I think that there's still more waves of that probably to come ahead. But that you have to actually watch the data to see if that monetary stimulus comes back. I think the fiscal alone is more that crowding out effect. That's kind of why we're in this like twilight zone right now.